Thanks, Steve. So I have a very complicated slide which I'm going to step through fairly quickly. But I mean, essentially, we really need to drive investment to the outcomes that society wants, and to align our policy objectives with how the financial system delivers value. And so the EU is actually, this graphic partly comes from the EU Action Plan itself. The EU has actually put together some key challenges and some areas that the Action Plan is designed to address. David's gone through some of these before, but really have no common definition of sustainable investment, risk of greenwashing, banks and insurers often giving insufficient consideration to climate and environmental risks, investors disregarding sustainability factors or underestimating their impact, and too little information on corporate sustainability-related activities. So what has the EU done about it? Well, we've heard they have a classification system or a taxonomy that's been developed. What is current best practice in the market? Because I think what this is going to require is a combined effort between policy and other actions amongst the financial services, the capital markets in general, and then also corporate best practice, and you can probably add quite a few other boxes or columns to that diagram as well in terms of societal expectations and outcomes as well. So I just wanted to go through this because I think in terms of investor best practice, there isn't really best practice today, if we're honest, in terms of how funds are declaring themselves to be green or otherwise. And that's why you have a number of different practices at play. You have many funds that are calling themselves the greenest fund on the planet. It's very hard to verify those claims. And then in terms of corporate best practice, there's lots of standards about how to report, but there aren't necessarily very clear standards about what is a good way of classifying an asset or an activity. There are things like the Climate Bonds Initiative, but there are a broader set of considerations such as green activities, green revenues, to take into account beyond the assets themselves. The second area is greenwashing. So really we do need some common definitions to avoid greenwashing, or SDG washing, as I heard recently. And so that's important to have some standards and labels that are derived actually from a common classification system. And again, I've left these boxes pretty open because from an investor best practice, if you're a big pension fund, like a sovereign wealth fund, and you're issuing mandates, and you want to issue mandates that make a difference as well as deliver some sustainable outcomes, at the moment, you really have no way of verifying the claims of the different asset managers coming to you to win those mandates. It's very, very difficult. We've worked with the world's largest pension fund, GPIF, which is the government pension fund of Japan. It's $1.45 trillion under management, and they have a big problem because they don't know how to identify really how the mandates and how the asset managers are running their businesses, running the funds on their behalf, and what outcomes they're delivering. So we still have a fundamental transparency problem in markets today. And that's why we've developed a lot of different solutions for that, but really it's going to require policy interventions and the market to react as well. And then in terms of corporate best practice, there are quite a lot of companies that are actually looking at ways of disclosing green revenue streams and green assets. And you've heard from Ian actually about how you can build accounts to do that. Banks and insurers not giving sufficient consideration. Well, I mean, the truth is that a lot of supervisors are now really examining this issue. So supervisors start taking more account of exactly what banks are doing. There's one supervisor anecdotally that just asked a very simple question. Can you give us an understanding of how you measured climate risk? And they asked that question of both an insurance company and a very large asset manager. And that simple question to the chief risk officer in both organizations created a huge change. So all it takes is sometimes one question. It doesn't have to be mandated in concrete, but that one question created a significant change such that both of those organizations committed to divestment of coal, having examined the issues and the risks. And markets are reacting to that as well. So I think we're seeing insurance companies applying the same kind of rigor they've applied to the liability side of their book to the asset side of their book in terms of how they manage assets. Investors often disregard sustainability factors or underestimate their impact. I mean, it's very clear that there are strong links between environmental, social, and governance factors and financial outcomes. S&P Global Ratings, about 2 weeks ago, published a paper that illustrated that it was actually an examination of a meta-study of thousands of different studies that showed overwhelmingly that most of those studies found a positive correlation between good environmental, social, and governance performance and good financial outcomes. So some asset managers are really looking at that, and asset owners and banks, and they're integrating that into their asset allocation decisions. But I guess what we need to see more of is explicit mandates. And then companies, I think there's an opportunity there to realize for companies, because for asset managers and banks, their job is actually to identify good investment opportunities. So for companies, I think companies actually need to make themselves as visible as possible when companies are investing in good practices, are investing in sustainable outcomes. And that can be a challenge, but I think extremely clear reporting and extremely clear dialogue with the investment community is going to be required. And bear in mind that we now have, as Steve mentioned, and this is quite important, we now have indices being developed on low carbon benchmarks, ESG benchmarks. And the reason why that's important is because there's an increasingly amount of passive investment. So this is rules-based investing. Once you set the rules up, it just goes. The computer goes according to what the computer has defined, a set of rules up front. So if you're a company, you need to make sure that you're very visible to the rule makers in that process so that you can attract the investment. In Japan, GPIF, the fund I mentioned before, published a very clear set of rules and allocated a mandate of $15 billion in one go, and told every Japanese company in that mandate that they were doing that and that they wanted the companies to track where they were positioned in that index relative to a normal benchmark. And trust me, because we run the data that sits behind that index, the response from Japanese companies has been overwhelming. That was the one thing that changed behavior in Japan in the last year above all other things in the corporate landscape. And so I think that dialogue and actually understanding the rules of the game is super important. How, as a company, can you be positioned better if you are investing in sustainability? And then this leads into the last point here, too little information on corporate sustainability-related activities. So there's a non-financial disclosure directive in Europe that covers 6,000 large companies. But few people actually know about that in reality. Few investors know about that, and a lot of companies even don't know about that. And the reason why is because it's quite hard to define sustainability rules for companies to disclose on. We've seen many organizations try and not necessarily succeed in doing that. But as I say, I think the reason for that is because people see this as a risk to disclose more, but actually it should be seen as an opportunity to attract more capital and better shareholders if you're a company. Which leads me to a story about risk and opportunity. So let me start with risk. I think transparency is really the key. Imagine if we were here 200 years ago and we were thinking about accounting rules. We would be thinking about how you would set accounting rules to define ways of classifying risk. We would be thinking about ways of defining value, pricing of assets, things like that. So just a little story I'll tell about China in the last minute or so. In China, between 1949 and 1997, there was a huge amount of logging for the global construction industry, really fed the global construction industry with timber. That logging at the time, because people didn't know any better, was clear fell. So it was by and large just clearing timber. Through 17 different provinces in China, the timber was completely cleared out. What happened in 1997 was essentially a severe drought which caused the Yellow River to dry up for 267 days. Unprecedented event. That actually shut down industry, agriculture, and residential water users who migrated as a consequence of that in that year. And then the following year, devastating flash flooding occurred in the Yangtze and other major river basins, which resulted in the loss of 4,150 lives, displacement of millions of people, and economic damages estimated from that event at about $30 billion. Now, if you add up all of the damage created by the droughts and the floods, and the deforestation, and the loss of fertile soil, and many, many other issues that were created by that prolonged period of economic activity, the damage was almost twice the entire value of the timber sold between 1949 and 1997. So if you're not pricing risk correctly, your long-term result could be completely disastrous. So I just tell that case study because it's sort of cautionary. And I think China has reacted as a consequence to that case study, and also a case study on air pollution, which has shown that air pollution costs China close to 10% of GDP in healthcare costs. And you would live 5 years less, 5 to 10 years less in China if you lived there in a long period of time because of air pollution. So these are economic facts that prior to about 2010 were not well understood in China, but after that created a big policy shift. Couple that with another story of transparency, which is in May 2011, so 8 years ago, close to this day actually, Puma, a footwear manufacturer, published probably nearly the first environmental profit and loss statement. So this was an attempt at creating a new accounting paradigm. And some of that work went on to kind of form part of the natural capital protocol that Ian's been talking about today. And they published that the damage they created was 145 million euros. And both in terms of their manufacturing and also in terms of their supply chain. And actually, that was half of their profits. So against all the advice of the communications teams, the investor relations teams in Puma, the CEO actually published those numbers. And on the day that the numbers were published, the share price went up by 6%. Why? When you ask the investors, well, because actually it showed that having a handle on the numbers on risk and being transparent about it, and coupling that with a clear action plan, Puma had put themselves ahead of the competition on risk assessment and preparedness for the future. So actually, since then, Puma and its then parent company, Kering, has actually attracted a whole set of new investors, a new breed of investors. Investors who are actually interested in sustainability. And on average, those investors who are interested in sustainability have locked into their share for a much longer period of time, which has actually reduced the volatility of the share price and therefore enhanced the value of the company. So that's an example of transparency on risk versus a complete lack of knowledge on risk. So I just wanted to leave you with those two